Even as the global economy adjusts to high inflation and rising interest rates, it is hit with another surprise. There are concerns about the Chinese economy and banking system collapsing. The depositors in China are racing to banks to withdraw their funds, indicating an oncoming crisis. How did the Chinese economy, which is seen as a worldwide growth engine, end up in this condition? And what effect does it have on the global economy? It is unsurprising that China is already experiencing widespread financial troubles, with more to come as the property sector's woes become visible within the banking system. An unprecedented credit bubble that has driven China's development over the last decade is now unraveling and weakening the economy. Defaults on a variety of asset classes, as well as failures at banks and other financial institutions, have sparked new concerns among depositors and investors about when Beijing will ultimately act firmly. Losing credibility has repercussions, since Beijing has historically intervened in times of financial stress and has thus far been the main crisis-averting force. When local government finance vehicles begin to fail on their bonds, Beijing will have to actively handle the problem, most likely by issuing new bonds. Since 2001, when China joined the World Trade Organization, the rest of the world economies have become more and more interconnected. Over time, the country has surpassed the United States as the center of the global commercial system. Several major global corporations like Apple and Tesla have significant manufacturing operations in China. China's proportion of global exports has doubled from 4% in 2001 to 15% in 2021. The U.S., on the other hand, saw its share fall from 12% to 8% within the same time period. According to the Purchasing Power Parity metric, China has surpassed the United States as the world's top economy. During the COVID-19 pandemic, the influence of Chinese commerce on the global economy was evident. China has evolved as the key location in the global electronic goods supply chain throughout time. As the entire economy rapidly adopted digitalization in the aftermath of the pandemic, demand for these technological items skyrocketed. However, there has been a significant shortfall in electronic products supplied from China as a result of lockdowns and supply chain interruptions. Following an increase in outbreaks, the Chinese authorities implemented a zero COVID-19 policy and imposed strict lockdowns in important areas such as Beijing and Shanghai. As a result, China's economy is predicted to develop at a slower pace in 2022 and 2023. The International Monetary Fund, or IMF, has reduced China's 2022 GDP growth forecast from 4.4% in April 2022 to 3.3% in July 2022. The IMF has reduced China's GDP growth forecast for 2023 from 5.1% to 4.6%. According to the report, lockdowns and the worsening real estate crisis have caused growth to be lowered down by 1.1 percentage points. The seeds of today's difficulties in China were sown during the 2008 global financial crisis, when the Chinese government provided large-scale stimulus to confront the worldwide recession. The government provided banks with an implied assurance to extend credit, resulting in a substantial increase in bank lending in about 2008. The majority of credit was diverted toward real estate and property, causing prices to soar. For a long time, experts have warned that bank lending is unsustainable and would lead to a disaster. The credit-to-GDP ratio, which is frequently used to predict a crisis, has been one of the highest in China. There were times when prices fell dramatically, like in 2011 and 2015, and a banking crisis appeared imminent, but was prevented by the government. Even when the latest price decrease is not as severe as in 2011 and 2015, it has become a catastrophe as the government battles COVID-19. The IMF has reduced its 2022 growth forecasts for both China and the global economy from 3.6% to 3.2%. It attributed the lower revision to economic downturns in China and Russia. According to the IMF, a Chinese downturn would have large worldwide spillovers. If supply from China falls, global consumer goods prices may rise, as observed during the pandemic. The slowing of the Chinese economy and consumption may result in decreased demand for commodities and intermediary goods produced by other nations. This may reduce inflationary pressures, but it may cause issues for economies that rely on exports to China. Additionally, the financial markets may well be impacted by the world's general slower growth. The fact that China's financial markets are not well connected with the rest of the world, as its commerce sector is a saving grace. As a result, spillovers will be restricted to trading channels. The financial markets will be affected, but only slightly. In contrast, the United States' heavily interconnected financial markets resulted in financial channel spillovers during the 2008 crisis. Undoubtedly, the housing sector's unfavorable attitude and weak real estate activity have hampered growth. This has had a significant impact on the economy, as property and other industries that contribute to it account for up to 1/3 of China's GDP. When trust in the property market is low, people are concerned about the entire economic situation. Mr. Quilge remarked, "Some homeowners don't believe their homes will ever be finished, since purchasers have refused to make mortgage payments on incomplete structures. The decline in demand for new homes has decreased the requirement to import building materials. Despite Beijing's effort to support the real estate market, property prices have fallen by more than 20% in dozens of locations this year." Analysts believe that with property developers under pressure, authorities may need to do much more to restore trust in the real estate market. A 2-year-long regulatory onslaught on China's tech titans isn't helping matters. In the most recent quarter, Tencent and Alibaba both saw a decrease in sales for the first time. Meanwhile, Tencent's earnings plummeted by 50%, and Alibaba's net income decreased by 50%. Tens of thousands of young employees have been laid off, contributing to a jobs crisis in which 1 in every 5 persons between the age of 16 and 24 is unemployed. In the long term, this might harm China's productivity and growth. Investors are also noticing a shift in Beijing, with some of the country's most successful private enterprises coming under increased scrutiny as Mr. Xi's hold on power gets stronger. As state-owned enterprises appear to be gaining favor, international investors are withdrawing their funds. During the same time that Warren Buffett's Berkshire Hathaway is selling its investment in electric car manufacturer BYD, Japan's SoftBank withdrew a sizable sum of money from Alibaba. Tencent has had more than $7 billion in investments removed in the second half of this year alone. Furthermore, the United States is tightening down on Chinese enterprises listed on the American Stock Exchange. Some investment decisions are being postponed, and some international businesses are attempting to expand output in other countries, according to S&P Global Ratings in a recent report. The world has become accustomed to the concept that Beijing may not be as open for business as it once was, but Mr. Xi is jeopardizing China's economic achievements in recent decades. The impact of extreme weather is beginning to linger on China's businesses as well. In August, a severe heat wave was followed by a drought in the southwestern portion of Sichuan and the central belt metropolis of Chongqing. As air conditioning demand increased, it overloaded the energy infrastructure in an area that is nearly totally dependent on hydropower. Factories, including big manufacturers such as Apple's Foxconn and Tesla, were forced to decrease hours or close entirely. According to China's Statistics Bureau, revenues in the steel and iron sector fell by more than 80% in the first 7 months of 2022, compared to the same time last year. Eventually, Beijing came to the rescue with tens of billions of dollars to help energy businesses and farmers.